Good day, and thanks for joining us for our webinar on Indiana farmland values and cash rents. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me today are my colleagues, Dr. Todd Kuethe, who's an Associate Professor in the Department of Agricultural Economics, and also the Schrader Endowed Chair in Farmland Economics. Michael Langemeier is joining us as well, who's also Professor in the Department of Ag Economics and Associate Director of the Center for Commercial Agriculture. So each year, this department conducts a survey regarding Indiana farmland values and cash rents. And that survey goes back to, I think, 1974, Todd. You've assumed the mantle of managing that survey the last couple of years. So we're really here to talk about, first of all, what the survey's about, who you talk to, and then obviously the results.
Yeah, so the survey dates back to the mid-1970s, in part because land is such an important part of the farm balance sheet, farm financial conditions. But at that time, there was very limited information. And so it's kind of has that legacy where we survey basically anyone whose professional duties, they interact with the farmland market, cash rental market frequently. So we have appraisers, brokers, some lenders, some large farmland owners or farmers. And we just basically ask sort of what's going on right now with your area in your county with land markets in terms of we split out by productivity, so we look at top, average, and poor quality land. And that's based on, we also ask them their subjective corn yields. So what do you think that thresholds are? And report at the state level, but also at the 6 regions around the state. And we also do look at recreational land and land transitioning out of agriculture as part of that as well. But we'll mostly focus, I assume, on productive farmland.
So I think the viewers are probably interested in this next chart, which is your results sorted by land quality category. And the results kind of jump off the chart. I mean, the percentage increase was unbelievable.
Yeah, and it's the record for all the years we've kept the survey in terms of percentage change, right? So we're looking at in the neighborhood of 30 to 34%, depending on land quality, which we were up last year as well. So we've been sort of regaining our sort of gaining momentum in terms of speed. Last year was up a bit of a surprise, and then this year up even more so. But it's not altogether surprising, right? So Iowa State does a similar survey of land values. They run theirs in the winter time or fall. And so last year they were reporting Iowa land values up 29%. So I mean, it's sort of happening around the Corn Belt.
Yeah, it wasn't shocking in that sense, but it is shocking when you look at the historical data.
If this is the only report you look at every year, then it would be very shocking.
Yeah. So this chart kind of gives us a little bit of a long-term view. So why don't you kind of walk us through a little bit?
Yeah. So if we go back to sort of the 70s, late 70s where we peak and then dip during the sort of farm financial crisis into the mid 1980s, and there was just really a slow gradual rebuild up till about 2008 or 9 when we started to see commodity prices take off, interest rates very low, and it really had a boom period up till about 2014 where land values peaked. And then there was a little bit of a value decline and then kind of held steady for a number of years. And over the last 3 years, it started to tip back up again. So we get this kind of smile over the last kind of decade or so.
Yeah, so if you look at the long-term trend, I think farmland values kind of bottomed out at about 1987, looking at most of the data sets.
Yep.
Gradual recovery in prices. And then we had a pretty sharp increase starting in that 07, 08, 09 era up through about 13, 14, right?
Yep.
And the growth, though, since that time has been pretty interesting looking at these nominal values. So I think, in 2014, top quality farmland in Indiana was 97.65, and this year you've got it at just under 13,000.
Yeah, it's quite a jump we've seen over the last 2 years. So, yeah.
So this chart looks at inflation-adjusted values. So far we've been talking about nominal values, not adjusted for inflation. Now you've taken a look at the nominal values versus the real values or the inflation-adjusted values, right?
Yeah, so again, sort of economist idea of inflation being that the price of everything is sort of price of all goods and services kind of goes up uniformly. And so with that, as inflation increases, we start to wonder how much of this price appreciation is just inflation versus the value of that asset. So the real here, what we're doing is dividing it by an index. In this case, it's the GDP chain deflator to look at if we were to set these values in today's dollars, what would the value be in previous years? So our last peak we're still above that in real terms in addition to nominal terms. So like last year, for example, we had a record high at that time, but it was below in real terms what we were seeing in 2014 because of, although inflation was relatively modest, it was enough to add up over those years to make the growth not. But now we're in both a new high in both real and nominal terms.
Record values, both real and nominal terms, which is interesting, and we'll talk more about forecast here in a minute. But one of the interesting things on the survey, going back a number of years, is where you ask people allow them to respond to a series of questions effectively about what's driving farmland values. So you might share those results with us.
Yeah, so we ask all the respondents, we have a sort of 10 kind of things that we associate with land value. So things like income, farmer liquidity, the return to other investments, anything that could drive the price of land values. And we ask them to rate, is this a positive force up to a +5 or a negative force to a -5. So these are the average for the last 3 years. And you can see in 2021, everything that could put pressure on farmland was a positive pressure. Everything was giving signs to like prices should go up. All this stuff is positive. Fast forward to this summer, 2022, again, almost everything is positive except for the interest rates. And so we're in a rising interest rate environment, which, as we'll explain more, I'm sure, in the future slides, puts downward pressure on land values. Because if we're having to pay more in mortgage expenses or cost of funds, then that will push down the amount we're willing to bid into the land value. So that's the only thing really pushing downward pressure this summer. Everything else still, we had a really good liquidity position. Commodity prices were better than expected they would be over the last few years. We've seen growth in exports. Ag policy continues to be accommodating. So all of those things are putting upward pressure on.
So really positive perspective both in 2022 and 2021. When I look back to the 2020 results, there were some things that were bothering people back then, right? People were a little bit worried about crop prices, livestock prices. Net farm income was a concern. Yeah, those have kind of gone away these last 2 years, it seems.
And I think 2020 is more representative of kind of a typical year if you're going to draw a random year where there's some things that are positive, some things that are negative, right? We have things that, the classic example are yields are good but prices are bad, or trade disruptions or policy uncertainty. But so the amount of positivity I think is rare historically in the data.
Yeah, and we'll talk more about the accuracy of that positivity last year in terms of what actually turned out here in a couple of minutes. But so the other thing you'd look at, and you mentioned this earlier, is you look at the regional variation in values. And there is a lot of variation as you move around the state of Indiana. So you might share some of those results with us.
Yeah, so again, we look at the land values, and this is all in the report, fully details. But this is looking at just the land value portion for this year, but we also have sort of last year to comparison, which we can use to make a growth. And so we're seeing really high growth, particularly in the northern part of the state, also in some land quality in sort of the southeastern portion of the state. But still those high values are kind of clustered in that sort of center part of the state.
Yeah, the interesting thing to me is that, west central Indiana, which we tend to think of as being the highest value part of the state, largely based on high productivity for both corn and soybeans, had compared to some of the other regions, modest growth. I don't know if I can call 16 to 19% modest, but compared to, say, Northeast, where you're looking at, 35 to 39% increase in prices or values?
Growth rates are always tricky to kind of wrap your head around because small numbers can have large growth rates easier in large numbers, right? So a dollar increase on something that's very high valued is much different than a dollar increase on something that's cheap, right? And so we tend to see that generally kind of in the economy, that the places where we see high values don't always have the highest growth because there's sort of convergence in the growth.
And just to remind the reviewer that you do have corn yields tied to the poor average top in every region.
Yeah, so it's possible to look and see where is my yield in that region? Where would I kind of fit in? Am I closer to the top?
And even do a price divided by yield and see how that compares across regions.
And we do that as well in the report.
Yes, it's in the report.
And that number is relatively stable, right? Yeah. So a lot of times that price difference is really productivity, but that sort of dollars per yield you can get from that land stays relatively stable across the state.
So one of the things you do is you ask respondents to the survey to anticipate what's going to take place over the next 6 months or so. And that's one of the more interesting parts of the survey.
Yeah, that's the part that I'm always most excited to see, right, is what do they think the future is going to be. And so here we're showing what we actually observed in growth rate for the second half of 2022. And then what we expect for the rest of 2022, right? So the observed growth rate was really high, and we have sort of optimistic but sort of modestly so respondents about growth rate continuing. So I think most people, if you said like, oh, can we get you 2.5% growth rate in a given year, they think that's pretty good. But coming off of those really high growth rates, in fact, if you look at the growth rate we've seen across from the previous survey, there was higher growth at the end of the previous year than there was at the beginning of 2022. And so there's already a sign that maybe that growth is kind of slowing or moderating. And it seems like our respondents sort of expect still positive, but at a slower rate.
Yeah, so put that in perspective. It looks like for the last half of this year, they're projecting a fairly modest rate of growth, right? 2.4% for average quality land, 2.7% for top quality, and 1.1% for poor quality. Compare that to what people were forecasting for the last half of 21 in last year's survey.
Yeah, so in last year's survey, they were much more optimistic going into 2022, that they thought 2022 could be a high growth year. And so they were right. We'll see if they're right again, but they were definitely, that's why we're talking about the sort of growth being surprising. It wasn't entirely surprising to all these respondents, I think. I think they, and in the comments we get, so also they'll give sort of comments. Last year they were saying like, oh, it's going to be gangbusters. Things are really going well. This year there was a little bit more like, things are good, but we're a little bit worried about inflation, a little bit worried about interest rates. So we're still optimistic, but a little bit more cautious.
Yeah, I thought that was one of the things that was interesting was last year's respondents were very bullish on farmland values, and their projections turned out to be pretty accurate in terms of comparing values from, say, June of 21 to December of 21, right?
Yep.
They anticipated pretty closely what actually took place, which was double-digit growth, right?
Yep.
Michael?
This is about what the average would be. I know more information for West Central Indiana because I'm going to talk about that later on. But the average over a long period of time, 5-6% growth rate, and so it'd be very consistent with that. Yeah. So that's how I would summarize that.
All right, so let's compare what's going on in Indiana to what USDA has collected. And you might back up for just a second and explain to viewers how USDA goes about collecting data. You explained how you do it here in Indiana. USDA has a little different procedure.
Yeah, so the USDA does an annual report, comes out usually around the first week of August. And it actually is from a June kind of production report that asks about cash rent and land values. And so they release sort of a nationwide, and they break it out, what they call here farm real estate. So that includes buildings, structures, improvements. They also have just cropland, or in a lot of states just pasture land. In some states they split out between irrigated and non-irrigated. But this farm real estate is sort of kind of the marquee number. And that's a sort of a weighted sample of farmers based on productivity and making sure it aggregates up to the to be nationally representative. And it's done at the sort of local level, aggregated at the state level, and then again aggregated federally. So it does tend to be a much smoother process, so you won't see sort of the rise and falls that you tend to see in surveys like ours. But it's sort of the best number kind of what's going on at the national average. And again, they're showing land values up quite a bit. Not as extreme of growth as what we have here in Indiana, but it's up quite a bit from the last year as well.
Yeah, I think in terms
12%.
of, we looked at the percentage terms earlier, and I think it was between 12 and 13% increase versus what you were showing for Indiana is about 30 or 31%. So one thing that I kind of pick up with respect to the difference in the surveys, your survey for Indiana really focuses on people that are, in a relative sense, pretty actively engaged in the farmland market. The USDA survey is people who are connected to the farmland market, but might not be actively engaged in buying and selling, and maybe not as close to contemporaneous activity. Is that a fair characterization or not?
I think so. The other thing I would sort of add, and I don't know how deep into the weeds we should go, but the USDA survey asks farmers about their farm. What do you think your farm would sell for? Where we ask sort of a hypothetical of what is the average of the high quality. And so they do a different sort of aggregation process to say from that farm to sort of the state level. where ours is kind of, it's not tied to any one particular parcel at any point. It's sort of, what's your characterization of the
Yeah, so I guess what the really conclusion is, you need to be careful about comparing numbers from the USDA survey to the Indiana survey that you conduct, or the Iowa State survey, for example, which is conducted in a way that's much more comparable to what you do.
But historically, the USDA number kind of hangs around our state level average. And if you look at transactions, it sort of hangs close to kind of the median, or the value that would split the top half and bottom half. So they all sort of go to what we consider to be sort of the prevailing kind of middle price.
Okay. So the other thing you've done is take a look at values coming out of these individual state surveys, again coming, in this case from USDA,
Yep.
and look at Illinois, Iowa, Indiana, Ohio versus the U.S. numbers. And there's a lot of difference.
Yeah, so the thing that always jumps off that bottom line is the one we had on the previous chart, which looked very dynamic. And when you look at it compared to what we see in the Corn Belt, it's very subdued, right? And a part of that is, again, productivity differences, right? So we tend to have higher values, but also values tend to, as you disaggregate it out at the state level, they think things kind of move around a lot more. So at the federal or the national level, you'll have sort of, parts of the country that are rising and falling, and so it kind of can average out to kind of a flatter number. But we see much more dynamic, and it's similar to what we see in our survey, to where we had that sort of rising period starting in sort of middle of the aughts, I guess you would say, up to about 2014, and then a dip or kind of flattening off, and then growth again the last couple of years.
So when you look at the values, and I'm looking at, for example, Iowa came in at 9,400 on the USDA survey, Illinois at 8,900, Indiana I think at 8,000, and Ohio at 7,200. And as you look at that and you start making comparisons, for example, on state level yields, do they match up, or?
Yeah, pretty much. I mean, I think it's similar to our survey in terms of if you could sort of translate this to productivity, it's gonna mostly average out, right?
So the differences in values across those states largely reflected in average yields across those, or expected yields across those states.
And also the sort of variability in the states sort of matters. Like, so Illinois and Indiana have sort of a stronger break in sort of north to south, I think, than Iowa. Maybe I'm mischaracterizing Iowa, but I think of Iowa as roughly more homogeneous or similar across the state, where there's a big difference between northern Indiana and southern Indiana. In terms of
that's a good point. Good point. All right, so let's just kind of summarize what you found in the survey overall.
Yeah, so new record high again, both in nominal and real value. But the real thing, I think, is the record growth, right? So it's not running a survey on an asset that tends to historically go up. You could have a new record high almost every year, but the new record growth was what really jumps out, and that's driven by a lot of positives in the market. Farmer liquidity, commodity prices, farm income are all very strong. The downside, or the sort of thing that's kind of keeping farmlands from growing even faster, is sort of fear about interest expenses and interest rates going forward.
And we'll talk more about that one in a couple of minutes.
Yeah.
But the interest rate consideration is a big one for farmland, right? So that's something we don't want to downplay too much, right?
Yep, exactly.
So the survey also looks at cash rental rates, and you might just share those with us.
Yeah, so again, similar, this is sort of the state level average. Top quality land averaging at $300 an acre, average at $252, and poor at the average is $207. And those are also growing by record amounts, between 10 and 13%, but also growing slower than the land value prices are growing, right? So
quite a bit slower, right? Your land value is up roughly 30% in round numbers, and you're looking at 10 to maybe 13% on the cash rental rates. Michael, you've looked at this quite a bit, I know, a few years ago with one of your graduate students.
Yeah, when you look at cash rents and land values and the growth since 2007, a 10% change is a big change for cash rents. You can get larger changes for land values, and we did. Not only last year, but some years around 12, 13, we had some pretty large increases there, and so this is not all that surprising. And what it really comes down to is we got different factors driving cash rent than driving the land market. Cash rent is really driven by net return to land. And so that kind of keeps it in a smaller band, if you will. Whereas land values has cash rent or net return to land, it has interest rates, it has inflation, it has alternative investments, it has all these other factors. And like you said, the stars were aligned in 22 to have some very large increases in land values, because all of the factors, in addition to net return to land, all of these other factors were positive, where cash rents is primarily driven by the very strong net return to land we saw in 21.
Well, I also think part of it too is the sort of negotiation process between
Yes.
landlords and tenants.
Yes.
Thinking, I mean, we're reporting this for 2022, but you almost have to go back to the
Fall of
previous year,
21.
fall of 21,
Yeah.
thinking about at that time, although we had these positive pressures with prices of, the other part of it is expenses, which people were very worried about growth in expenses and eating at their revenue. So maybe hesitant to want to bid land, cash rent higher in the case of for the farmers.
So, Todd, it's interesting to look at the cash rents over time, and we've just taken those and plotted the top, the average, and the poor going back to 2000. And it's pretty interesting, especially when you think about that 300 versus where we were just a few years ago. On top, cash rent was 294, and that was like back in 2014. When you start thinking about that in inflation-adjusted terms, have we set a new record or not?
No, we're still kind of below the previous record in those real or inflation-adjusted terms, right? So even though inflation hasn't been very high for that whole time, just a small amount of inflation added up over several years kind of can eat away at that sort of price run-up. So, and I think that maybe kind of goes into Michael's point about sort of how these are determined as sort of two different economies and two different markets. And so between the bidding process, the looking at how you can justify what your rents should be, really changes that. The other thing I should say too, I always kind of stress when I talk to audiences that, like, my personal opinion is that cash rent is the hardest number to measure, because it's not like there's sort of one rent. We're looking at an average that has a very wide dispersion. Most people that farm, to support a household will have multiple landlords, and so even the cash rent at their farm can be quite different based on all these sort of negotiation points, right? So people always come to me and say, I think your rent numbers are wrong. And I say, well, what do you think they should be? Half of them think they should be higher, half think they should be lower, right? So I guess that's how you get to an average. But
depends on whether you're renting ground or
yeah.
or the owner of the ground.
So the other point you made to me earlier was the fact that on all three of these categories, top, average, and poor quality land, we've kind of crossed over some maybe some psychological thresholds almost, if you will, right?
Yeah, I think for whatever reason, people gravitate towards sort of $50 breaks or $25 breaks. So the idea of 294 to 300, even if you had that same prices in the same year, 300 feels very different than 294. Like 300 belongs up here, 290s are down in the 200 area. And the same with 252 and 200, right? So we kind of, I think a lot of the initial feedback I've gotten discussing what we found around the state and to other folks, that sort of like, oh, now you've crossed 300 or now you've crossed 250. Or in the case of low, cross 200. That somehow feels very different than if I had sort of, 249. Somehow 252 feels different. So it is something I think psychologically we kind of anchor on.
The other thing that kind of jumps out at me as I'm thinking about the rental values and looking at the chart and looking at the historical data is on the top quality land, you're showing on a nominal basis $300 rent versus $294 when we peaked back in, I think, 2014. Actually, it might have been 2013 now that I think about it. Average quality and poor quality are showing bigger relative jumps since they peaked back in that 2013, 2014 time frame. Anything going on there that you...
Yeah, I'm really interested to turn that one back to you guys, because you guys seem to understand. I think a lot of it has to do with productivity differences and what you could do with poor quality land or average quality land, or also our risk management policies, crop insurance, marketing. I think there's a lot of things that we've had a lot of effort in the ag sector to take the worst of what we've got and make it as good as we can. I don't know if we've seen the same sort of effort at taking the top and making it even better. That's my hunch. But
I think that's part of what's going on, because I was commenting to Jim earlier that yield, that subjective yield for that average productivity, really jumped the last year or two, and so it seems like we're making the average productivity ground. Maybe that's also true of the poorer quality ground, though it's not that poor by Indiana standards.
It's still good. Yeah.
It's still pretty good ground by Corn Belt standards. We're bringing up the subjective yield for that ground, and so I think that's part of what's going on.
So this is interesting. I think we've got maybe a master's student
thesis
here.
This is a testable thing. We can try to
this is interesting. But I think it's very noticeable to me that there was a relatively larger jump in the lower productivity categories than what showed up in the high productivity category, which wasn't what I was expecting offhand, but it clearly shows up in the data.
Well, the other part of it that kind of ties in, and now I'm just like trying to think of research projects I want to do this year. The ratio of the cash rent to land values, if there's no difference in sort of investment across one or the other, that ratio should hold relatively the same, right? And so if we're in a case where we've been sort of investing more in bringing low productivity land up in productivity, then that should also be reflected not just in the cash rental rates, but in the land values relative to the other cases. So. Yeah, I don't know. This will be fun.
All right, so we've got some more data digging to do.
Yeah, I'll be back.
Hypothesis. So you've broken out the cash rental rates on a regional basis. Again, looking at the different productivity categories within each region. So share those with us.
Well, again, this kind of ties into your points earlier about your expectations of the land values. Those all hold much more clearly in cash rents, right? So the most productive land should rent for the highest, right? And so that's kind of what we're seeing in terms of the clusters around the state. The growth rate, again, kind of positive growth almost everywhere. We only have one case, the average quality land cash rental rates in the southeastern portion dipped just slightly. But everywhere else, we've seen pretty good growth, highest growth being in sort of that northeastern portion of the state.
Yeah, and looking at Southeast, which is kind of interesting, you mentioned the average productivity actually dipped a little, 1.5%, but really all three categories, very little change.
Yeah,
right?
Yeah, relatively stable.
So that was maybe a little bit of a surprise, thinking about it. And Michael, I know you pay a lot of attention to West Central. Your case farm that we feature on a lot of our programs is based on West Central Indiana. $329 for the top quality. Does that surprise you at all?
Not really. When I was having conversations last fall and this spring, when people were saying rents, there was quite a few people talking over 300, and so that wasn't real surprising. The 10% wasn't that surprising. We're going to talk a little bit about the model I used to predict rents in West Central Indiana. I was predicting about an 8% increase in cash rent. It came out at 10%.
So speaking of models, and
I would like to point out, though, I should have mentioned on that chart, there is a rent per bushel. That's a very important number for people that are thinking about what my ground should rent for. I really encourage them to take a look at the region they're in and look at that rent per bushel number. I get that question a lot. You know, what is your corn yield? And then you multiply that by the rent per bushel. It'll give you some idea of at least in the ballpark of where your rent should
Maybe
be.
you should offer a number people can call you. No, I'm just kidding.
And that is a table you have in the report.
Yeah, in the report
Yes.
we break down the cash rent also similarly sort of by what they reported as the yield for that top average and poor quality. And then we can just divide the cash rent by that to get the similar idea of like, what are you paying in rent to get a bushel of corn, essentially.
All right, so we talked about the impact of interest rates on farmland values. So let's talk about the model behind that a little bit.
Yeah, so usually when I give this in a talk, I will go very slowly and first warn them that I'm about to show them math, right? Because they're not always wanting to have a professor come in and show them some kind of equation. But this, if you've ever taken an Economics 101, Finance 101, this is just the net present value, right? So the value of any asset that's a productive asset, we just think of it as what could we expect to get from owning it? What are those expected returns that the owner gets? But then we want to discount those in the future, right? So we want money now, not into the future. And there's the whole inflation, the future may not happen, we're impatient consumers, there's returns, other things we do with our money, right? There's opportunity costs. So we discount things farther in the future, but we can sort of shave off some of that discount rate if we think there's going to be a high growth in those returns. So we think there's going to be really high growth, and we know we're discounting in the future, but we want that to kind of be reflected in the value. And so this gives us sort of a very simple model, like the old joke, all models are wrong, but some are useful. This is a pretty useful way of thinking about land values. And when I think about, what values currently are, also when I think about what things are going to be in the future, I think about expected returns or income. I think about discount rates, and I think about potential for growth, right? Mm-hmm. So if we just assume a really simple, everything is sort of going to grow at 1%, relatively modest growth rate. And if we look at sort of our returns, think about these sort of like, cash rental rates that we're talking about, right? So $200 cash rent, as we shift around that discount rate, the amount of money we can justify paying for that to get access to that return changes pretty quickly with just small changes in those discount rates. And so, I often sort of tell the joke about, borrowing money from my dad when I was a teenager versus when I was in college. Like the discount rate seemed to get a lot easier as I started to show I could pay it back, right? And often I think about it also in terms of, when I go and talk to farmers or farmland owners, everybody always talks about some sale in their area, and they just don't understand how this person that bought it could justify that. I often say, like, well, they clearly just have a different discount rate than you, right? So they're willing to think that that makes sense to justify based on even just subtle variations in that discount rate.
And it could be a different growth rate, obviously.
Oh yeah, or a different growth rate. Yeah, if they think they can get it to grow.
Or expected returns are different. Maybe they think their expected returns are higher.
Yeah, somewhere out of those three variables, you can get to disagreements pretty quick.
Yes, you can.
Right, just by even just small changes in one or the other.
Yeah. And so just walk us through the numbers there, because I think it's instructive to think of how much impact a change in that discount rate can have on the expected value of that asset.
So if we take 200 and we divide it by 3% minus 1%, right, 2%, that'll give us $10,000, right? That's what we could justify paying to get access to land that we could cash rent out for $200, right? But if we increase our discount rate to just 4.5%, so it's not a drastic jump, in holding that growth rate constant, it'll fall all the way, 5,714 there, right? So it's easier to look at 3 and 6 because those numbers are nice and round. If we go all the way up to 6, we'll drop down to 4,000, right? So just changing what we think about our discount rate, or even if we have the same discount rate, but we just are able to change what we can expect in our returns, then we can go from, for example, at a 3% discount rate, from $10,000 to $15,000 to $20,000 just by $100 increment changes in that expected return.
Yeah, so as I look at the chart that you've put up here on the screen for us, one of the things that I think is quite striking is we think about rising interest rates over the next several years. It could have a pretty large impact on people's willingness to pay for farmland, right?
It does, but again, it comes down to, as I know we're going to talk about, which discount rate should we think about, right? So there's a lot of attention particularly in the financial press or the ag press about sort of the short run sort of policy rates set at the yield curve, or the sort of low end of the yield curve, what the Fed's doing, what's going there. But it's really for mortgages, it's out at that longer end, right? So we look at more like the 10-year treasury, or look at farm mortgages directly when we can, to say, like, what's kind of happening at that sort of scale, because we're looking at financing something over several years. Changes in the short run yield really, or the short end of the yield curve, really affect sort of decisions for this year, but it's things in the longer run that affect sort of multiple year decisions. But in either case, all of those rates are sort of been inching up over the last year.
Yeah, so let's take a look. You've looked at the cash rent to land value ratio, which is another way of tackling this topic.
Yeah, so we just think about what percent of that value can we get, and so we call this sort of the cap rate. And you can see that really since the mid-1980s, we've seen pretty much a uniform decline in the cap rate. We had been holding steady for the last 6 or 7 years at around 2.5, so we've dipped a little bit again. But this again goes back to our discussion that the land values are rising faster than the cash rent. Mm-hmm. And so you get this sort of suppression of the cap rate. I was actually just talking to a group of farmers this morning. I said, well, the good news is, this is how economists tell good news, this isn't unique to the ag sector. There's sort of a suppression of cap rates across productive assets in the economy. This is not sort of unique to farmland, but we are seeing this sort of continued pressure, which again kind of gets to the idea of what value could we justify paying if our percentage of return that we're expecting to receive continues to decline. Is that going to put some downward pressure on what people are willing to bid?
So let's think about those discount rates in a little more complete fashion. And you've taken a look at 3 common rates that get quoted a lot in the press.
Yeah, and I often use this to sort of stress to people that are interested in the land market that there's a lot of attention to what the Federal Reserve is doing about setting the federal funds rate, right? So this is the policy rate. This is the overnight deposit that the Fed will pay to banks. And so when the Federal Reserve Committee, the Federal Open Market Committee, meets to set the rate, this is the rate that they're targeting. And it's been inching up over the last several months, right? So if we go back to, so I always think going back to sort of 2009, where we had the Great Recession and the Fed cut rates drastically, held it low for a long time, and then we're sort of inching them back up again. And then we had COVID and all the financial challenges there. They cut the rates again. And so now as we're near full employment, inflation pressures are ticking up, the Fed is saying, well, we need to start raising rates to sort of make sure the economy doesn't get too hot, or also if there's a recession in the future, we want to be able to cut rates, right? So I often say that it's like the reason I give my kids a tablet is so that I can take it away later, right? So we want to raise them now so that way in the future, if we need to cut back, we have wiggle room to do that in the policy. But I also sort of argue with farmland that doesn't matter as much as some people say. So if you go forward, so the prime rate, this is what a bank charges to their best business customer for short-run loans. Generally speaking, prime rate is 3% above Fed funds rate. So the banks don't make a lot of money here. This is basically the cost of doing business, turning on the lights, paying for your employees. And so you can see there's almost like a perfect one-to-one step. The Fed raises the Fed funds rate, prime rate goes up in lockstep. So then go forward, one more. The farm mortgage rate, and this comes from the Federal Reserve Bank of Chicago, does a survey of ag lenders. So this is representative kind of for farm mortgages in Iowa, the northern 2/3 of Illinois and Indiana, the southern 1/3 of Wisconsin, and the lower peninsula of Michigan. That's that sort of region of the country. So kind of Corn Belt plus maybe. And you can see that it generally kind of tracks with the Fed funds rate. They tend to kind of go up together or go down together, but it's not a one-to-one correspondence. It's not that because the Fed raising interest rates is more of a symptom of what's going on in the economy when we think about land values than it is the cause. It's not like the Fed directly changes what the mortgage rates. The mortgage rates are set among bond traders in a market. They're absorbing the same information as the Fed, but they don't always respond the same. In fact, if you look at the sort of spread between the farm mortgage rate and the prime rate, that really tells us what is the relative risk from a lender's perspective of funding the purchase of land versus loaning it to businesses short term. So sometimes that rate can get spread out quite a bit if they think there's more risk in the ag sector. Other times it can go all the way to sort of a negative spread if they think there's more risk now of loaning to businesses short run, because if a farm mortgage fails, at least the farm gets to own, the bank will own a farm, right? There's still some base value there. So as we think about interest rates going forward, there's sort of this rise in all of the interest rates, but the one we need to really think about is what's happening sort of at the farm mortgage rate. That's what will affect the price of land.
So looking at the chart and the history, I would characterize the farm mortgage rate relative to, for example, the federal funds rate as drifting in the same direction, right?
Yeah, they're sharing information. They're linked, but not a one-to-one correspondence.
But if you look at what's happened here in the last, maybe since the beginning of this year, they look like they're moving pretty tightly.
Yeah, and they definitely have periods where they move together pretty tightly, right? So, but I think the sort of what's causing them to move is one of the things that sort of can create confusion among people in the marketplace. So the Fed is raising rates based on economic conditions. Mortgage or bond traders are also raising rates based on those same things, but it's not sort of because there's a policy shift we're going to see, right? Because we can also see it's sort of what was happening around 2009, where the Fed cut rates drastically, farm mortgage rates fell by a bit, right? So I think we may also kind of end up with that same thing. The other thing is, we're starting from what could be sort of the natural floor of all of these series, so they're all going to kind of go up together. But I would expect to see some divergence over the next couple of years in terms of
going back to the projections that the respondents had for the last 6 months of 22, I can see why they're concerned with the increasing interest rates. I agree with that, but they still are relatively low. I think that's what we got to remind the viewer here is even though they're increasing a little bit, and they're not done increasing, they're going to increase some more here in 22 as the Fed fund rate goes up. They're still relatively low historically.
And history doesn't have to be that far, right?
Yeah.
We still have a long way to go just to get to where we were 2007,
Yes.
8 when we had the previous farmland price boom. But I do think we're going to see continued upward movement in all of these. And I think it's the pace of the movement that'll really dictate how much this impacts land values. But also the other thing is just the sort of the anticipation that they might go up in the future can be enough for people to say, I don't know if I want to bid that high because it's going to keep going up, right? And so,
So I think the consensus is all three of us agree with the survey respondents that going forward, one of the negatives on farmland values is clearly going to be what takes place with respect to interest rates, right?
Yep, oh, for sure.
So let's just kind of summarize what you found on cash rents.
So cash rents are up 10 to 13%. And we've seen so although they're growing again at a record level for cash rent growth, that still is much less than we've seen in the growth of land values. So we have this sort of continued compression of that sort of cap rate or the rents relative to land values.
Michael, you've taken a pretty detailed look over a number of years now with
Yeah.
respect to cash rents, and you might share your results.
Yeah, what I'm doing here is showing the relationship between cash rent and net return to land. This is for West Central Indiana average productivity soil, but the relationship would hold across the Corn Belt. And there's a couple things that are very important from this chart. One is that cash rent is much smoother from a trend standpoint than net return to land. It's not near as volatile. It's another way to state that, not near as variable. And so that's pretty obvious. But what's maybe not so obvious from this chart, but it's very important to understand, is net return to land is very, very important in determining cash rent, particularly looking at is it high statistical significance between looking at lag net return to land and cash rent the next year. There's a very close link there. And so I wasn't that surprised that we saw that increase in 22 because as this chart shows, 21 was a very good year in terms of net return to land. Looking ahead, this is obviously a projection. We still got quite a ways to go here before prices are determined for the 22 crop, but 22 doesn't look that bad. And so how I want to summarize this chart is there really isn't that much downward pressure on cash rent right now. Even though net return to land is significantly lower in 22 compared to 21, we're still looking at support for the current cash rent levels.
Yeah, and so looking at your projections for net returns, first of all, I think we should talk about where those came from. Those are based on your simulation of a farm in West Central Indiana, one that we use in a lot of our programs, but a typical corn soybean operation, roughly, I think maybe it's in terms of scale, about 3,000
Yes.
acres, right? So you've simulated that going back over time, and that's where you come up with your net return to land calculations. The cash rents, of course, are coming out of the survey. As you look at what took place in 21, I mean, the rise relative to 20 was phenomenal. So just to put some numbers on it, in 20, your estimate was net return to land of 331. Your estimate, and you've got some assumptions built in here in terms of marketing, but still over $500 an acre net return to land, right?
And so I think where you're coming from is, why didn't cash rent increase more? There's negotiations that take place here, and so that's very important to point out. But it takes a really large change in net return to land to drive a change in cash rent. And from the model that I use, a $100 increase in net return to land increases cash rent $10, and so it's not a 1-to-1. It's 10 to 1. It takes a really large change in net return to land or a decline in net return to land to reduce cash rent. Why is that? Well, I think part of the reason is people are looking at kind of an average return over time rather than 1 year, and so they're saying, well, if they were going in last fall, they're saying, well, 21 looks pretty good, but that's probably not going to stay. stay $500 per acre for the next 5 years, and when they start the negotiations, they don't increase it as much as net return to land. I think this makes sense from a negotiation standpoint, because you don't want cash as an owner of land or as an operator. You don't want cash rent making these 15-20% changes from one year to the next. You want something that's more smooth.
So looking at your projection, do you expect any downward pressure on cash rents for 23?
No, flat to maybe 5% higher. 10%, I think, is unless returns start looking a lot better here. Corn price starts jumping, and we have record yields, which it doesn't look like we're going to have necessarily. I think we're looking at a 0 to 5%. This is the actual model, just to show you that it does have a decent fit, but there's years where it's not perfect. Certainly that 10, 11, 12, 13 period was very difficult to predict what was going on with cash rent. But I underestimated a little bit this year, but it was relatively small. I think it was a $5 difference between the actual cash rent in the report compared to my projection.
Okay.
Okay, let's shift gears here a little bit. This is actually the inverse of the capitalization rate that Todd was talking about earlier. And the reason why I do this is I want to relate this to the price-earnings ratio for stocks. And so I invert this and then take a look at how it compares to the long-run average. And obviously, the farmland price to cash rent ratio is relatively high. This is just another way of saying that the capitalization rate is relatively low. Can it remain that high? Well, I think this increase in interest rates is going to put downward pressure on this ratio. And so I don't think we're going back to that 20 anytime soon. That would be going back to a 5% capitalization rate. I don't think that's going to happen, but I do think there is some upward pressure on the capitalization rate and some downward pressure on the price to rent ratio. This is a really busy slide, and so let me determine some of the terms here. And what I'm doing here is rather than looking at just 1 year rent, I'm looking at a 10-year average rent in relationship to farmland price, because as we saw that previous chart, 1 year can be a big outlier, $500 for 2021, for example, and so I think when people are negotiating cash rents and thinking about profitability, they're thinking more long term, and so this chart reflects that. I've got farmland price divided by an average, moving average of cash rent, a 10-year average. I've got a price divided by a 10-year average of net return to land, and then I've got the S&P 500 index divided by the 10-year moving average of earnings. And so I want to start by looking at the relationship between the green line and, let's just say, the P-Rent 10. Which is the farmland price divided by the moving average of cash rent. It's obvious. There's two things that are very obvious when we compare farmland to the stock market. Number one, the stock market is much more variable. That's true. And then another thing I want to garner from that comparison is there really is not a close link between movements in the stock market and movements in farmland. I mean, researchers, Todd, have been looking at that for years, and we've been finding that result for years. But I thought I would just show this graph to illustrate that. The other thing I wanted to show with this graph is it seems like the red line and the blue line are in equilibrium in 2022. And so what I mean by that, it doesn't seem like cash rent's necessarily higher than what the previous 10 years of earnings would suggest, or vice versa. And so I think we're very close to being in equilibrium in terms of cash rent and net return to land from a long-run perspective.
Okay.
Another chart, a couple charts I want to look at here is just to show how good of investment farmland really has been. And so I've got two charts that are related to this. This first one is the 10-year rate of return. Here returns include the cash rent value and capital gains, and so I'm adding those together to get a rate of return in relationship to the P-Rent 10 ratio. And as the P-Rent 10 ratio increases, you'd expect to get lower returns, and so there is a downward trend on those triangles. I didn't fit a line there, but certainly there would be a downward trend there. But another thing this chart shows is how good this land market has really been the last 10 years. If you look at 2011, which would be looking at returns from 2011 to 2021, and then 2012 to 2022, it's been a pretty solid return, despite the fact that we've had a high farmland price to rent ratio. And so you're looking at returns during the 2011-2012 period, if you bought land in those years, at 6-7%. And so that's really interesting, because one of the things we talked about in previous webinars related to land values is what's going to happen when we start seeing these high price to rent ratios. Are we going to see some very low returns? Well, obviously, so far the answer is no.
So I have to ask, Michael, there's a couple of triangles on the chart that are in one case below zero and a couple others that are just barely above zero. And I have to ask you what years those were. I've stumped him.
My guess is this goes back to 1960. My guess is that's during that 1980s period when you had some declining land values that it just didn't hold up. And so, despite the fact you were getting a fairly decent cap rate, the cap rate was relatively high. You had negative capital gains, and they just weren't holding up.
Okay. So you're not predicting a return to that?
No.
Okay.
We're not predicting a return to the 1980s.
All right.
This one here should make people optimistic that own farmland. This is looking at a 20-year rate of return. And so we go 20 years ago, investing in land in 2002, and then what was the return 2002 to 2022 in relationship to the P-rent ratio, and that large green triangle there is the latest observation we have. And granted, the P-rent 10 ratio was only 20 at that time, in 2002, but the return was well over 10%. And so a very healthy return here for the last 20 years. But probably the most remarkable thing about this chart, and again, this is 1960 to 2002, a very long period of time, it never drops below 6%. Think about the stock market. If you have a 10-year period or 20-year period, does it drop below 6%? Probably. Think about bonds. Do they drop below 6%? Probably. And so this just tells you how resilient the farmland market really is in terms of generating positive returns.
So I'd just like to point out that the chart points out how resilient it has been in the past.
Yes.
The past is not necessarily a predictor of the future.
And as we go into these very, very high P-rent ratios, we're literally off the chart. And so we're kind of in uncharted territory there, and so the proof will be in the pudding. We'll keep presenting these in future land webinars and see where we stand.
So Todd, am I going to get a forecast out of him here? I don't know.
I don't know. We'll see. Is he going to tell us an amount and when? Well, at the same time,
I think that is the big concern, though, that the high P rent ratios that we're at today, what will those returns be 10 years and 20 years out?
Particularly given that we've got a different interest rate environment. We've got to remember that you go back even 10 years, the interest rate environment really was not that different. We had low interest rates. They weren't increasing. They didn't have anything. They were going down. If you look at a 10-year moving average of interest rates, they were coming down. And so we're in a different environment right now. And so that's a little concerning. For those high P-rent ratios we've seen recently, it's certainly a little concerning, and we could see lower rates than what I'm showing in the charts here for 10-year and 20-year. That's certainly the case.
Well, as people that study the dismal science, as they call us, the good news would be, though, if things are worse off, it's probably worse off across the entire economy, right? I don't think we'll be in a case where the ag sector is plummeting relative to everything else, right? So the same things that would put downward pressure relative to the past are also true of anything else you want to invest in, right? So I would expect sort of long-term farmland sort of continues that place where it's slightly higher returns than the safest investments, but much lower variance than the higher risk investments, right? It kind of sits comfortably in the middle between sort of equities and bonds.
Yeah, and kind of add to the P-rent ratio, we've went through a period since 2007 where there was a lot more positive factors for farmland than there was for cash rent. Again, they're different markets. I think we're going into a phase now where we could see some just as big, if not slightly higher, increases in cash rent than farmland values because of that increase in interest rates. And so this will be an interesting period to watch. And what that means is some moderation of this P-rent ratio.
Well, I think it'll be interesting to see too with, the other sort of elephant in the room is inflation. And
Yes.
What's been changing with inflation. And as the negotiation process starts up in the fall, if you're seeing your expenses, all of your other expenses inflating, how much are you willing to justify on higher rents, even if your returns and commodity prices are inflating as well? So I think that's the other kind of thing that I'll be really curious to watch, is to see how that negotiation process works out under this, it seems like we always say high uncertainty, but now it feels like high uncertainty or something, right? Like the what's going to go on in that sort of return space going forward. So.
And just to kind of follow up on that a little bit, from our recent ag economy barometer surveys, the thing that they list as their biggest concern, Jim, is input costs by quite a ways. They're more concerned about input costs than they are prices and many other things. And so you're right. That's going to enter into the cash rent negotiations.
I guess the other thing that we picked up on the Ag Economy Barometer surveys is the fact that there appears to be a divergence between people's short-run expectations for farmland values versus their longer-run expectation. So short-run, we're picking up more negativity, or maybe a better way to say it is less positivity, because the index is still at a relatively high level, but it's dropped significantly compared to where it was last fall. Whereas the long-term index in that survey, for our viewers that don't follow that, the long-term in that context is defined as 5 years out versus 12 months for a short run. They are much more positive. They've lost a little bit of the positive outlook they had last fall, but not near as much as what they've lost with relative to the short term. So we're picking up that tremendous uncertainty about the short run, which I think is inflation, input cost, output prices, and interest rates. But from a longer term perspective are more confident of really kind of the things you were talking about. And I guess to reiterate your point, Todd, if we do see something that's really negative for farmland values, it's probably going to be very negative for things like stock market values as well, right?
Yeah.
That's kind of where you're coming from.
Also to put in a plug, you mentioned the CME barometer. In the report, we also have a number of articles, like one that outlines Michael's thing, but you guys had a nice one about the CME barometer, farmland expectations, that you wrote with our grad student, Chad Fichter. So it was nice to...
So with that, I'm going to wrap up today's webinar. So thanks for joining us. The full report that Todd's referenced a couple of different times is available on the Commercial Ag's website, purdue.edu/commercialag. When you get there, click on Publications on the main menu bar, and one of the selections actually talks about the Farmland Values Survey. So you'll go directly to that. Our next Outlook webinar will be on September 16th. Michael Langemeier and Nathan Thompson will be joining me for that one. Of course, that will follow the release of updated crop production estimates from USDA, as well as updated world ag supply demand estimates from USDA. And of course, all of this will be on our podcast, Purdue Commercial AgCast, and you could subscribe to that and wherever you get your podcast, as well as listen to it on our website, again, purdue.edu/commercialag. So on behalf of my colleagues, Michael Langemeier and Todd Kuethe, I'm Jim Mintert. Thanks for joining us.